Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. Let's check out a couple of growth and income stocks now with Todd Bunton, our growth and income stock strategist here at Zacks.com. Here's one that I don't think anyone has talked about before, Intercontinental Hotels Group. PLC, so they're a British-based company, right?
Yep.
IHG is the ticker symbol. They run a string of hotels.
Yeah, they're actually the world's largest hotel group by number of rooms. Their most famous brand's probably Holiday Inn. So Holiday Inn, Holiday Inn Express. Yep, they own them. They also own Crown Plaza and their own Intercontinental hotels, more upscale.
Right.
But the company's been doing very well. They've actually kind of relaunched the Holiday Inn brand. I don't know if you've noticed the different hotels, along the interstate or whatever. They've kind of revamped that image a little bit, and customers are responding well. Revenue per available room, which is a common metric, it measures occupancy rates and room rates. That's actually been increasing over the last several quarters, actually across the board. And the company's actually been growing strong overseas as well. About 51% of the revenue comes from outside of the U.S., so they're growing strong in the emerging markets. China, they're in there, so that's a big growth driver for them, obviously. And analysts have been actually raising their estimates over the last several months. It's driven it to a Zacks number 2 rank buy. As you can see in the price and consensus chart, over the last several months, really, the company's been beating estimates, and analysts have been raising, so it's kind of a stair-step pattern. And analysts are expecting pretty strong growth here. Based on consensus estimates, they expect 25% earnings per share growth in 2011, 16% growth in 2012, and that's really coming through, like I said, higher revenue per available room, so decent sales growth, but big earnings per share growth. That's because they have a relatively high degree of operating leverage. They have high fixed expenses, so if they can fill in those rooms, that's great because it covers their fixed costs. So that's really driving double-digit earnings per share growth. They also pay a dividend that yields 2.9%. So you're getting growth, you're getting solid income, and you're not paying a whole lot for it. The company trades about 14 times forward earnings. That's a discount to the industry average of 18 times, and a discount to its historical median of 19 times. So there's a lot of value here.
All right. Then you've written about Brinker International recently as well. EAT, the ticker symbol. Where's the growth? Where's the income here?
Okay, this is an interesting name. The company actually owns the Chili's brand, Chili's restaurants.
Oh, hence the ticker EAT.
Yeah, exactly.
Okay. So that's going to be one of my questions.
It's a restaurant company. So they have about a little over 1,500 Chili's restaurants, and they also own the Maggiano's Little Italy restaurants.
Yep.
I know they have some. They only have about 45, so it's definitely a smaller chain than Chili's, but there's actually been a lot of growth there, and in Chili's too. They've seen 2-3% same-store sales growth at Chili's, about 5, 6, 7% same-store sales growth at Maggiano's over the last few months. So they are seeing growth despite a difficult consumer environment. So that's led to a string of 4 consecutive positive earnings surprises, and again, higher analyst estimates. So it's a Zacks number 2 rank buy, and analysts are forecasting strong growth for the company over the next 2 years, 21% earnings per share growth in 2011, 17% growth in 2012. And management actually came out with a target to double their earnings per share by the year 2015. So if you figure that, that's about 18% annual earnings per share growth. So that's very solid there. And they pay a dividend that yields 3%. So you're getting good growth, you're getting good income. And the company has actually raised this since they started paying a dividend in late 2005. They've raised it at an average annual rate around 16%. So that's heading in the right direction. That's something we like to see. And their payout ratio is 36%, which tells me that they have room to continue increasing that in the future, especially if they're going to grow earnings per share. So you're getting all of that, and you're getting it at a very reasonable price. They trade around 11 times forward earnings. The industry average is 17 times, so it's a significant discount to that. And its 10-year historical median is 15 times forward earnings, so it's a discount to that. So a lot to like here as well.
Okay, do you own either one?
I do not.
All right, you will want to check out other stock pick suggestions that we have on our homepage, Zacks.com, and you'll want to check back frequently because those picks change from day to day. We put 2 new ones up there, no, actually 4 new ones up there for you daily, one in each of the investing categories that we write about. Got a little confused there for a minute. With Todd, I'm Terry Ruffalo.